expenses to sell that product. The expenses go down below the revenue, and because it supported the revenue, so we got revenues on the income statement, we got expenses on the income statement. Now, if we subtract the two, revenues minus expenses, we get net income. Now, net income is how profitable the company was during the period, during the week, the month, the quarter, the year. So net income is the result of the income statement. It could be a loss, it could be a net loss. Ideally it wouldn't be, we'd hope it would be net income, but it could also be said net loss. But in this case, net income. Alright, so we got revenues minus expenses. Now, one thing to note, the rule of expenses, the main rule of all reported expenses is that expenses are reported when they are incurred, whether or not cash is used, or whether or not cash is let's read it, whether or not cash is paid in that period. Alright, we're going to get to GAAP in a second, but GAAP is going to ignore cash. It's going to say, did we have this revenue, whether or not we received cash? Yes. Okay, record as revenue. Did we have an expense, whether or not we paid cash? Yes. Okay, record an expense. We'll get into that later. But the one thing to note is net income or net loss flows into the statement of retained earnings. Now let's talk about what retained earnings is. Retained earnings is basically the accumulated profits or losses that a company has held within the business. Okay, so the statement of retained earnings shows the amount of earnings that have been retained in the business and the amount of the company's resources paid out to stockholders as dividends. The basic equation is beginning retained earnings. If it's the first year or first period, that beginning retained earnings is going to be zero because the company just started. There's no profits to retain. So we got beginning retained earnings plus net income minus dividends equals the ending balance in retained earnings. It's the amount of profit retained within the company. Moving on to the statement of cash flow. The statement of cash flow shows how cash was affected during the period. Specifically, how cash was affected from our basic transactions. Basic transactions, operating, investing, and financing activity. So how was cash affected? Remember when I said on the income statement, revenues don't necessarily have to, there doesn't need to be a cash exchange. We don't need to receive cash to record revenue, and we don't need to pay cash to record an expense. Well, the cash flow statement says, whoa, if there was no cash transaction, I don't want to include it on that. So statement of cash flow just says, what happened to cash? Did I pay somebody? Yes. Okay, record it here. Did I receive money from an investor? Did I actually receive the cash? Yep. Okay, include it in that statement. Statement of cash flow says just cash. None of these non-cash transactions, and we'll get into how non-cash transactions work in a later lesson, but statement of cash flow is just cash. Now, supplementing all of those four statements is our notes to the financial statements. Throughout our lesson plans, we're not going to go into further depth about what's included to the notes, but just know conceptually, notes provide more information about things already included in the other statements or relevant information that's not included in the other statements. Alright? So it's a resource to provide more information that's either about the transactions, our accounting policies, like how we record revenue and how we recognize revenue. That's the kind of stuff that's included in the notes. It's important for a reader to know, and that's why it's there. But for the purposes of this lesson and the principles of accounting, we're not going to need to know any further depth. But just know the concept. Notes provide additional information about information included in the financial statements or relevant information not included in the financial statements. All right. So you'll see how the cheat sheet's set up. In the top, middle, moving to the right, we have this thing called Generally Accepted Accounting Principles. GAAP, all right, in parentheses, GAAP is the acronym for Generally Accepted Accounting Principles. Nobody likes saying that all the time, so we came up with this acronym, GAAP. What is GAAP? I'll use an analogy. GAAP is like the grammar of accounting. English is a language. Accounting is a language. English has a grammar so that when we put words together, it makes sense and people can compute and comprehend. Just like English, accounting has a grammar. It has rules that so that when we put accounting business transactions together, they make sense. That grammar is called GAAP. So similar to language, we could put words together, they may not make sense. Car, blue, person, hit. Well, those words register, we recognize those words, but in that order, it doesn't make sense. We have to switch around and say the blue car hit the person, right? So we need to put in a specific order so that it makes sense, so that we understand. That's what GAAP does. It says, you got transactions here, financing, investing, operating, all these transactions going on. Let's put them together so that they make sense to a reader, That's what GAAP says, and GAAP gives us that outline, that sort of grammar to the structure. Now you'll see, come down below, you'll see this thing that says Financial Statement Auditors, CPAs. And what CPAs do, for example, they're like the English teacher. If the financial statements are like a paper or an essay, and we'd want them to be grammatically correct, right? Well, so the CPAs are like the English teacher. They grade the paper and they say, oh no, you got to change this. You got to put a preposition here. You know, this doesn't work. You need a page break, paragraph break, whatever. You know, it doesn't work. That's what CPAs do. They say, no, these financial statements don't make sense. You need to put this here, you need to put that there, you need to add this, add that. So they're like the English teachers. They're grading the papers. They're saying, is this GAAP? Is this grammatically correct? Yes, no, add this, add that. Okay, now, so CPAs sign off on the financial statements. They're the ones saying, yes, this is correct. All right, so they're the English teachers, they're the graders, but you don't receive a C, you always got to receive an A. It's always got to be correct. But anyway, that's the sort of analogy. GAAP is the grammar underlying financial statements. CPAs are the ones grading that, testing that, making sure it's correct. All right, so that's basic understanding of how financial, or how we get to financial statements, how we make sure they make sense. Now, if we turn the cheat sheet back over, we'll see an example of financial statements, and I'm going to go through this pretty quickly because these concepts are pretty basic and they're all defined here. But I want to go through how these financial statements are intertwined and how they connect to each other. And so you'll see, top left corner, you'll see we have a balance sheet here, and then we have definitions on the line items, and we have that for each of the 4 financial statements. And you'll see that the HMS Roundbelly is the title of our company, balance sheet, and it's as of September. Like I said, it's as of a certain date. You'll see down below on the income statement, for the period ended. It's for a period. Date, period. But it's going to be the date of the balance sheet is going to be when the period ends. All right. So the period ends September 30th. Well, let's look at our balance sheet at September 30th. All right. May not get that, but you can watch this tape over. Don't be taking notes. Just watch the tape over. You're going to be able to watch this tape more than one time. Sit there with your cheat sheet. Go through the concepts with me, but don't take notes. It's all here. All right. And so HMS Roundbelly, HMS Roundbelly it's a ship that's going to take us on this journey to accounting land. All right. It's accounting land. We're going to get there. It's not a very exciting place. It's not a very exotic place. It's not a very fun place. But HMS Roundbelly is the ship that's going to sail us to an understanding of this foreign language, which is accounting. All right, so we're on this ship, HMS Roundbelly. We're going to follow its business transactions. It's going to take us to the accounting land, and it's going to give us a better understanding of what accounting is. Now, so let's go through HMS Roundbelly's balance sheet. You'll see you got current assets. You got your total assets. The total assets equals the total liabilities plus stockholders' equity. Hey, that's a basic accounting equation, right? Assets equals liabilities plus stockholders' equity. Sounds familiar? Well, that's what the balance sheet is. Assets plus the liabilities, assets equals the liabilities plus stockholders' equity. Now you'll see it reports things like cash, property, plant, and equipment. Those are assets. There's a description here. You can read through there. You'll see liabilities, accounts payable, unearned revenue. There's a description here, a little bit more in depth. But note that we're going to go through each of these transactions in a subsequent lesson and get a better understanding of how each of these works to get to this balance sheet. Similarly, income statement, we have revenue, like we talked about on the other side. We got revenue less our expenses. That equals net income. Well, that net income, it flows to our statement of retained earnings. Like I said, the basic equation for the statement of retained earnings is beginning retained earnings. Like I said, this company started this year 0 plus our net income less any dividends, anything we pay back to the stockholders. Then we have our ending balance of retained earnings, the amount of income profit that is retained within the company. So that income needs to go to the statement of retained earnings. Similarly, that ending retained earning balance needs to fall into our basic accounting equation. So that goes here on the balance sheet. Those two need to equal, just like net income here needs to equal net income there. Now, going up to our statement of cash flows, we got operating activities, investing activities, financing activities, but just cash. Like I said, accounting GAAP requires us to report everything that happens within the business, whether it's cash or not. Well, the statement of cash flow says, forget that, let's just look at what cash happened. So that goes through, but we start with our beginning cash balance, then we go through all of our cash transactions to get to our ending cash balance. That ending cash balance needs to agree to our cash balance on the balance sheet. Now, I went through this fast. I went through a very high level, but you have the detail here. Watch this lesson again if you need to. Conceptually understand what's going on. Next, we're going to move on to recording journal entries and getting a better understanding of how basic transactions become financial statements. That's lesson 1. Thank you very much.